Hi, everybody. Max Callahan here from Siegel and Callahan with Jerry Brown, attorney and commercial litigator, and also head of our firm's practice research group to talk about data centers. It's a rapidly evolving area in real estate practice. And to guide us through, Jerry, can you kick us off with what makes a data center unique as a piece of real estate?
Well, data centers are different from most of the other commercial or industrial property classes, and one of the big challenges for determining their fair market value is that for a data center, the bulk of the value is in the contents, the personal property, the servers, the other IT equipment, and all the HVAC apparatus to service that. The assessor is supposed to be determining simply the real estate value, the shell, the raw land, how it sits, but not the contents or business value or other tangible value. So when data centers are transacted or come online, our challenge is to make sure that the valuation really is for the real estate, but not the contents for these other components. And data centers come in a variety of sizes and kinds. There are some data centers that are rather old, or on the older side. There are buildings that in many cases had been designed to do something else, and then they were converted to data centers. And again, more modern data centers are usually built in suit. They are intended to be a data center and nothing else. So the issue of whether a data center is a special purpose property is something that assessing offices have to deal with. So in a lot of the methodologies that are used to evaluate other property class types don't yield reliable results when applied to a data center.
That's fascinating, actually, because it seems that the data centers, just because of the unique issues in every specific valuation method, kind of defy what we would expect that method to produce. So we're talking about three methods: sales, income, and cost. Each one has its own unique twist. Can you kind of guide us through that?
Sure. Well, for sales, where you're relying on sales of similar properties in that category in the last 30 years, the challenge with doing it for data centers is that many of these transactions will include the sale of the contents. So how do you identify the portion of that purchase that was for the real estate as compared to the other components of the purchase? For the income expense analysis, again, the leases for a particular data center, the question will be, does this lease also include other services? Is the lease a financing vehicle? Was this a sale and leaseback or arrangement? So you really need to examine the instrument, whether it's a license or a lease, to really make sure that what's being relied on reflects the real estate value rather than business value or payment for other services or as utilities and financing vehicle. The challenge with the cost approach is the issue of accurately calculating the depreciation. The technology for building data centers is rapidly evolving, continues to evolve rapidly. So to reliably determine what the depreciation is in doing the cost approach is a real challenge. And the assessors here in Cook County have identified that as a problem in terms of you relying on the cost approach with respect to data centers.
Right. So with everything moving so fast, it's difficult to gauge how quickly the contents are depreciated. So I guess to summarize, there are a lot of challenges, a lot of issues here, and it's all the more critical to aggressively get on top of those, because with municipalities now looking for stable sources of revenue, data centers are a target for a municipality, and it's important for owners and managers to make sure and watch carefully so that they're not being inequitably taxed.
And that's correct. And keep in mind, Illinois is a bit different than some of the other states in the country in that other states actually do tax personal property, whereas Illinois does not. So whereas in Illinois, one of the first things we want to look at is to make sure that the real estate value is not improperly including personality or other tangible or business value. In other states where they are being taxed for the personality, you want to make sure that you're not seeing someone being double taxed for any of that, that components that are included real estate value aren't also being in some way taxed as personality again.
So data moving fast and assessment practice having to run to keep up. So everybody, thank you so much, and Jerry, thank you for guiding us through this challenging area of assessment practice.